Welcome to Wealth Unlocked, the podcast dedicated to demystifying the world of finance. Today, we're diving deep into a topic crucial for anyone looking to grow their money: investment guidelines in the USA. Whether you're a seasoned investor or just starting, understanding the unique landscape of American investments is key to building a secure financial future. We'll cover everything from the basic concepts to regulatory protections and smart strategies. So let's unlock some wealth together. First things first, why invest in the USA? The U.S. market is one of the largest and most dynamic in the world, offering unparalleled opportunities for growth, innovation, and diversification. Investing here means participating in a robust economy driven by leading global companies. But what exactly is investing? At its core, it's committing money or capital to an endeavor with the expectation of obtaining an additional income or profit. Instead of letting your money sit idle, you're putting it to work. We'll explore various avenues, but remember, the fundamental principle is growth over time, often outpacing inflation. The American market offers a diverse array of investment vehicles. Let's break down the most common ones. Stocks. When you buy a stock, you're purchasing a small ownership stake in a company. As the company grows and profits, the value of your stock can increase, and you might receive dividends. Bonds. Bonds are essentially loans made to governments or corporations. In return, they pay you interest over a specified period and then return your principal. They're generally considered less risky than stocks. Exchange-traded funds and mutual funds. These are professionally managed collections of stocks, bonds, or other assets. ETFs trade like stocks, while mutual funds are bought and sold at the end of each trading day based on their net asset value. They offer instant diversification. Real estate. Investing in physical property, whether residential or commercial, can provide rental income and capital appreciation. It's a tangible asset, but often requires a larger upfront investment and ongoing management. Choosing the right vehicle depends on your risk tolerance, financial goals, and time horizon. One of the strengths of the U.S. investment market is its robust regulatory framework designed to protect investors. Key agencies include the Securities and Exchange Commission, SEC, the primary federal agency responsible for enforcing federal securities laws, proposing new securities rules, and regulating the securities industry, the nation's stock and options exchanges, and other activities and organizations, including the electronic securities markets in the United States. The Financial Industry Regulatory Authority, FINRA. This is a self-regulatory organization overseeing broker-dealers in the United States. FINRA's mission is to protect investors by ensuring the securities industry operates fairly and honestly. The Securities Investor Protection Corporation, SIPC. SIPC protects customers of brokerage firms that go out of business. It covers up to $500,000 per customer for cash and securities, including a $250,000 limit for cash. This is not protection against market losses, but against firm failure. Understanding these protections can give you confidence as you navigate the market, but always remember to do your due diligence on any investment. Taxes are an unavoidable part of investing, but with smart planning, you can optimize your returns. Capital gains tax. This is levied on the profit you make from selling an investment. Short-term capital gains, assets held for 1 year or less, are taxed at your ordinary income rate, while long-term capital gains, assets held for over a year, typically have lower preferential rates. Dividend income tax. Dividends received from stocks are also taxable. Qualified dividends are taxed at the lower long-term capital gains rates, while non-qualified dividends are taxed as ordinary income. Tax-advantaged accounts. The U.S. offers various accounts designed to help you save and invest for retirement with tax benefits. These include 401ks, employer-sponsored retirement plans where contributions are often tax-deductible and growth is tax-deferred until withdrawal. Individual retirement accounts. You can contribute to a traditional IRA, tax-deductible contributions, tax-deferred growth, or a Roth IRA, after-tax contributions, tax-free growth and withdrawals in retirement. Consulting a tax professional is always recommended to tailor a strategy to your specific situation. While investing offers the potential for significant returns, it also comes with risks. The key is to manage these risks effectively. Diversification. This is perhaps the most crucial strategy. It means spreading your investments across various asset classes, industries, and geographies to reduce overall risk. The old adage, "don't put all your eggs in one basket," holds true. If one investment performs poorly, others might perform well, balancing your portfolio. Asset allocation. This refers to how you divide your investment portfolio among different asset categories, such as stocks, bonds, and cash equivalents. Your ideal asset allocation depends on your age, risk tolerance, and financial goals. Younger investors with a longer time horizon might opt for more stocks, while those closer to retirement might favor a more conservative, bond-heavy approach. Regular review and rebalancing. Markets change, and so do your life circumstances. Regularly review your portfolio to ensure it still aligns with your goals. Rebalancing involves adjusting your portfolio back to your target asset allocation. This often means selling some assets that have grown significantly and buying more of those that have lagged. And that brings us to the end of our Beginner's Guide to Investment Guidelines in the USA. We've covered the basics, explored key investment vehicles, understood the protective regulatory landscape, touched upon crucial tax implications, and discussed vital risk management and diversification strategies. Remember, investing is a journey, not a destination. It requires patience, continuous learning, and often professional guidance. Don't be afraid to start small, educate yourself, and consult a financial advisor to help tailor a plan that's right for you. Thank you for joining us on Wealth Unlocked. Until next time, happy investing!